It's pretty wild to think about how one single piece of data can be like a stone dropped into a calm pond, sending these massive ripples out across the entire global economy. Well, we just saw a perfect example of that play out in real time.
I mean, how is that even possible? How can one number from one report completely flip the script for the entire global market? It sounds kind of crazy, but that's exactly what happened. So, in this explainer, we're going to unravel that strange and incredibly powerful connection between a single economic report and trillions of dollars in assets. So, where did this all start? Well, it began with that stone I mentioned. It was a routine data release that was supposed to be pretty boring, but it turned out to be anything but. I'm talking about the August jobs report.
22,000. That's it. That was the number that just changed everything. And to really understand why this was such a bombshell, you have to know what everyone was expecting to see.
I mean, just look at this. The gap is huge. Wall Street economists, the people paid to predict this stuff, were looking for 75,000 jobs. What we got was less than a third of that. This wasn't just a small miss. This was a complete shock to the system. And when you dig into the details, it actually gets worse. They went back and revised the data for previous months, and it turns out June's job growth was actually a net loss, the first time we'd seen that since 2020. Add in unemployment ticking up to a multi-year high, and the message was crystal clear. The job market isn't just cooling off, it's getting cold, fast.
And that single report immediately backed the world's most powerful financial institution into a corner. I'm talking about the U.S. Federal Reserve. All of a sudden, their hands were tied.
So you gotta put yourself in the Fed's shoes here. They were caught between a rock and a hard place. On one side, you've got the risk of inflation, things like tariffs pushing prices higher for everybody. On the other side, you're now staring down a potential job market collapse that could absolutely drag the economy into a recession. They had to pick their poison. Which fire do you fight? And, well, they made their choice pretty clear. This quote from Fed Governor Christopher Waller was a huge flare signal to the markets. This bad jobs report gave Fed officials the political cover they needed to basically say, okay, our focus has to be on jobs right now. And this is the key takeaway. The Fed officially pivoted. They sent a message to the entire world that, hey, we'd rather live with inflation being a little sticky, a little higher for a while, than risk the job market completely falling off a cliff. Okay, so the signal from the Fed, it set off this bizarre, totally counterintuitive chain reaction on Wall Street. It was like all the old rules just got thrown right out the window. This is the part that, understandably, confuses almost everyone. We just got some really bad news about American jobs in the economy. So why on earth did the stock market go up? How does that make any sense at all? Well, it all comes down to this one kind of backward piece of Wall Street logic called bad news is good news. See, for investors, any fear about the slowing economy was totally wiped out by the excitement that the Fed was about to step in and cut interest rates, basically pump the system full of cheaper money. That promise of stimulus, it's like rocket fuel for the markets. So let's actually trace those ripples. Let's see how the simple expectation of cheaper money cascaded across pretty much every major asset class you can think of. So the first and most direct hit was in the massive bond market. And the reaction here wasn't just fast, it was practically instantaneous. Traders were scrambling to get ahead of what they thought the Fed was going to do next. So the yield on the 10-year Treasury note, which is a huge benchmark for borrowing costs all over the world, it just plunged. The market didn't even wait for the Fed to hold a meeting. It immediately started trading as if multiple rate cuts were a sure thing, which sent bond prices soaring and yields plummeting.
All right, so from bonds, the next ripple spreads out to the single most important currency on the planet, the US dollar. The very same logic that was pushing bond yields down started to drag the dollar's value down right along with them.
And the thinking here is actually pretty simple. If you're a big global investor and you're going to get paid less interest to hold US dollars, well, there's just less reason to own them. Lower expected rates means less demand for the currency, and poof, the dollar's value starts to fall. Now let's look at physical stuff. Commodities like gold and oil, they reacted too, but boy, did they tell two completely different stories. Gold, which doesn't pay you any interest, suddenly looked a whole lot more attractive compared to bonds that are now paying you less. So its price shot up. But oil was totally stuck. On one hand, the prospect of cheaper money is good for oil, but the reason for that cheaper money, a slowing economy, means people are going to use less fuel. so it was caught in a tug of war. And finally, the last and loudest ripple hit the stock market. This is the reaction most of us see on the news. But if you look just beneath the surface of that rally, it's clear that not all stocks were created equal.
The whole market rallied, for sure, but the biggest winners were actually smaller, US-focused companies, the ones who benefit the most from lower borrowing costs right here at home. Investors also pivoted to what they call quality, companies with solid finances, instead of the more speculative, high-growth story stocks.
Okay, but here's the catch. This whole bad news is good news world is incredibly fragile. It's all built on a very specific set of assumptions, and investors are watching like hawks for 3 specific tripwires that could completely shatter this entire narrative. Tripwire number 1, inflation suddenly comes roaring back. That would tie the Fed's hands completely. Number 2, the job market goes from just cooling off to completely collapsing. Then, the fear of a really deep recession would crush the optimism about rate cuts. And number 3, the Fed just doesn't deliver. They signal that they're not going to cut rates as much or as fast as the market expects. Any one of those things could end this party in a hurry. And that really leaves us with the central, multi-trillion-dollar question hanging over everything right now. Is this market rally a vote of confidence that the Fed can pull off a perfect soft landing? Or is the market just getting high on the promise of medicine while totally ignoring the underlying disease that makes the medicine necessary in the first place? That is the question on everyone's mind.